Have you ever wondered how two of history's biggest financial bubbles brought France and Britain perilously close to economic ruin? The stories behind the Mississippi and South Sea bubbles are as captivating as they are instructive. Let's dive into these fascinating financial disasters and uncover the valuable lessons they offer. Welcome to Vaulted Visions. In this video, we delve into the most enthralling financial tales and their modern-day lessons. Don't forget to hit that subscribe button and ring the bell so you never miss an episode that could provide insight or save you from future economic pitfalls. To understand these bubbles, we need to set the stage. It's the early 1700s. Europe is finally breathing after the War of the Spanish Succession, which had drained national treasuries and strained economies. Governments are desperate for innovative ways to manage their war debts and stimulate economic growth. Enter John Law, a brilliant yet controversial Scottish economist and financier. Law was a maverick, believing that money wasn't just a medium of exchange, but could be a powerful tool for economic growth. His radical ideas about credit and paper money were initially met with skepticism, but he soon found an attentive audience in France's regent, Philippe II, Duke of Orléans. In 1717, John Law founded the Mississippi Company, acquiring exclusive trading rights in the French territories of North America. The company promised to exploit the vast resources of the supposedly bountiful Mississippi River Valley, encouraging investment with the promise of immense wealth. A speculative frenzy ensued. Shares of the Mississippi Company were exchanged for government debt, and investors from all levels of French society, from peasants to royalty, rushed to invest, driving share prices to astronomical levels. Law's introduction of paper money further fueled the mania, creating an illusion of endless wealth and prosperity. This frenzy, however, was based more on enthusiasm and speculation than on real economic fundamentals or profits from the Mississippi lands. Meanwhile, across the English Channel, British politicians and financiers observed Law's successes with great interest. In 1711, the South Sea Company was established with a similar aim: to manage and consolidate national debt in return for exclusive trading rights in South America. The South Sea Company promised massive profits from trade with the seemingly rich territories of South America. Like the Mississippi Company, its speculative potential caught on quickly with the public and amongst the elite. The British government's endorsement lent the company an air of extraordinary legitimacy. The stock prices skyrocketed, and the frenzy intensified as everyone from merchants to nobles, and even members of the government, poured money into South Sea shares. But behind the grand promises, the reality was starkly different. In 1720, as insiders began to sell their shares, confidence crumbled and the bubble burst, leading to a catastrophic financial collapse. Investors who had staked their fortunes on the South Sea Company were left bankrupt, and the country plunged into economic turmoil. The fallout from both bubbles was severe. In France, the economy was crippled. Public confidence in paper money and the banking system was shattered, exacerbating the national debt crisis and leading to decades of financial instability. It's argued that these financial strains contributed to the backdrop for the French Revolution later that century. In Britain, the collapse of the South Sea bubble resulted in widespread financial ruin, shaking public confidence in the stock market and leading to significant economic reforms. The government intervened to prevent complete economic collapse, leading to strict new regulations on financial practices. The most significant long-term impacts were the financial regulations born from these crises. In Britain, the South Sea bubble led to the Bubble Act of 1720, which sought to regulate the creation of joint stock companies and the establishment of more stringent accounting and financial practices. These regulations laid foundational blocks for modern financial oversight and corporate governance. To understand the relevance of these historical events, look at how similar patterns have played out in modern times. The dot-com bubble of the late 1990s and the housing bubble of the mid-2000s both saw irrational exuberance drive asset prices far beyond their intrinsic values, just as in the Mississippi and South Sea bubbles. How can you use these lessons in your personal financial decisions? Diversify your investments to spread risk, thoroughly research before investing, and remain skeptical of too good to be true opportunities. Additionally, keep a long-term perspective and avoid jumping into investment frenzies driven by hype. For professionals and regulators, these historical bubbles underline the importance of robust financial oversight, transparency, and ethical practices. Ensuring sound financial governance and being vigilant against systemic risks are pivotal in maintaining economic stability. The stories of the Mississippi and South Sea bubbles are more than just fascinating tales of financial folly. They offer timeless lessons about human nature, economic cycles, and the importance of prudent financial practices. By studying these historical events, we can better understand and hopefully avoid similar pitfalls in the future. If you found this exploration of historical financial bubbles intriguing, give us a thumbs up and subscribe for more fascinating insights into financial history and contemporary finance. Share your thoughts and any experiences with financial bubbles in the comments below. Thanks for tuning into Vaulted Visions. Stay informed, stay prudent,